Hey everyone, welcome. Hey Shondra,
Hello.
how are you?
I'm all right. How are you?
Okay. Do you have the presentation that you can share?
Yeah, I'll share the presentation from my computer. That's fine.
Great, because then you'll be in charge. All right. In the meantime, we're sharing the check-in screen. So please check in and I will stop sharing for a moment.
I'm gonna drop mine in. Okay.
Hey Shondra, you want me to do a little intro?
Sure.
So Chandra is somebody that I met last year. She came all the way out to our startup week in October. And she did such a great job with the financial aspects that she was teaching back then that we've asked her to join us to talk with all of you fine people about financials. She learned corporate finance and financial modeling as a technology investment banker at one of the fastest growing investment banks in the world. She co-founded TBC Capital, helping entrepreneurs get over six figures in investments and grants. She's currently the president of TBC Capital and an on-demand CFO for early stage companies. That sounds like it's really exciting. Okay, so take it away, Chandra.
Thank you again for that great introduction. I have been helping founders with their finance stuff for a number of years now. As was mentioned, I'm a former investment banker. And before that, I worked in HR with the FP&A department. And so I was kind of the liaison between people in numbers and accounting. So I've seen the operations of accounting from many different lenses. And so I decided to take all of that experience and drop it into the business that I'm running now, but then also all of the startups that I work with. And so we'll get into the financial management piece, but this was a slide that was in the deck previously that I did want to go over because I do think that it's super important for founders to look at their business from the lens of experimentation, especially when it comes to growth and the finance portion of that. I don't think that people consider how much it costs to experiment in their business, but it's super important to understand that that is part of the business. So what you'll always be doing in your business, no matter what stage you're in, you'll be in this predict, measure, analyze, and predict again cycle. And part of that is financially managing that piece. I had a client who 2 years ago was in this predict, measure, analyze loop, and their investors. And I'll talk a little bit about profitability in a second, but their investors were wondering why they weren't profitable a certain year, and that was because we basically spent all of their extra profits or all of the extra money that they made and put it back into the business because we were just experimenting on what would work. And now, 2 years later, they're profitable. They have very predictable marketing channels, but we wouldn't have had that had we not, one, been in this predict, measure, analyze loop, but then also decided to financially support that experimentation that we were doing in their marketing. Will they get this deck afterwards? Anyone? Yes? I'm assuming yes. Okay,
Yes.
perfect. All right, so let's jump directly into financial management. So most of you, I'm sure, have heard about the three financial statements that you as a business should always have. And I'm going to be honest, a lot of my clients, before they started working with me, did not even look at these, but they're very important for you to not only look at, but to use them to make decisions in your business. So the three financial statements that you should always be getting whether this is you doing your reconciliations, your bank reconciliations, using your accounting software, or you're getting it from your bookkeeper or your accountant. So you should be getting at least these three statements every month: your income statement, your balance sheet, and your cash flow statement. And we'll go through each one of these, but this is going to give you a good snapshot of your business. I would say that these are lagging indicators, so it's really hard for you to make decisions on the go with these, but it really gives you a good sense of the health of your business at the end of every month. So your income statement is going to give you your profits. Your balance sheet is going to give you your assets and liabilities, what is owed to you and what you owe. And your cash flow statement is going to be all the cash that comes in and out of your business. And the cash flow statement is something that it can be created from the income statement and the balance sheet. So even if you don't get a cash flow statement, you can create that from just having the income statement and the balance sheet. Okay, so like I said, the income statement is going to tell you your profitability or not at the end of the month. So it starts with your sales or your revenue, and then the next line item is your cost of sales or your cost of goods. So basically, how much money it takes you to sell those items that you did in that month. That's going to give you your gross margin. So that number is super important because it tells you how profitable the products that you sell are. And so even if it's a service that you're providing, you can say, let's say your service is $100, but it costs you $50 to provide that service, maybe in personnel, in time, in software. That means that your product is going to give you 50% margins, which means that you have $50 or 50% of the revenue that you made to actually run your company. So it's broken out into those, I guess, two sections where you have the profitability of your sales, and then you have the profitability of your actual company. So you start with sales, then you get down to cost of sales, or how much it costs you to produce those sales or those products. And then you get down into your operating expenses. This section is how much it costs you to actually run your business. There'll be a lot of fixed expenses here. So like your rent, your insurance, your salaries, your marketing costs, which is a variable cost, but it is here as well. And then your general and administrative expenses are going to be here as well. That's going to lead you down to your total expenses. Your operating income is your gross margin minus your total expenses, and then that'll lead you to your profitability. So this net income equals revenues minus expenses. That is the most high level, simple way to explain your income statement, but it's essentially a way for you to understand, in the most simplest of terms, how much money do I have left over after I sell my products and run my business. Okay, so here is a more detailed example of your income statement. So let's dive into this. So I'm not going to go into gross sales or net sales, but net sales are, I'll say this generally, gross sales are all of the money that you have coming in. So you have a product that is $100, but let's say you have a return, or you have to pay a platform a certain percentage of that sale because you use their platform to make the sale. So your net sales would be minus all of those little things that come once you make a sale on a platform or in other ways. So in this example, you have your net sales as $524. And then because it costs for you to actually produce those items, and in this example, this company sold 5,000 pairs of running shoes for $75 each. And And that would mean that their net sales are 524, but the cost to sell those 5K of running shoes was 288, meaning the cost of the shoe, the cost of the fabric, the cost of shipping, all of that was $288. And that leaves them with a gross income of $236. That means that they have $236 for them to actually run the business. And if you see here, the example says that each pair of running shoes cost $30. And so that is how they're getting the cost of goods calculation. And then I won't get into that here, but I talk a lot about contribution margin. So even if you have cost of goods, which is a good measure of how much it costs you to actually produce your product, the other thing that you want to look at is contribution margin, which helps you to look at all of the variable costs that it takes for you to actually produce your product. So that could be the people that are sewing the shoes. That could be the cost to pick and pack. So with your 3PL is a person that, or is the company that basically houses your goods and then sends them to your customers. But again, getting a little too in the weeds there, your gross income here is $236. That means you have $236 to run the actual company. Remember, we talked about operating expenses. So these are a lot of the fixed costs that you have to run your business. So that's salaries, that's rent, marketing, travel, any business, insurance, all of that goes into your operating expenses. And so that means you have leftover $27 of operating income. So you have your net sales, your cost of goods, then you have your gross income, subtract your operating expenses, and your operating income is left over. Some people stop there because a lot of businesses that are just starting, they don't really have any interest expense or income. They don't really have any other income. And so $27 would essentially be your net profit or your net income. But in this particular company, they have some interest expense. So let's say you have a loan and either you are spending, you're paying interest, or you have an account that's earning interest, so that would go here. Other income is random ways that you're making money. Let's say you did, I don't know, you were a vendor at a show or something. That could be other income. It's not your general way, your usual way of making money. And then you have your income before taxes. So now that 27 is now 33. And income taxes, if you are a C Corp, which if you guys are just starting, you're probably not a C Corp, you're probably, or you may be, it depends on if you're looking for investment or not. But if you are not, you could be an LLC, but taxed as a corporation, but that would go there. But again, if you're just starting out, many companies are not profitable, so there really isn't any income taxes. But here that gets to the bottom of the P&L with $33. So that is the net income for this particular 1KC example company. Any questions there? Let me check and see if there's any questions. And the one thing about me is that if you do have questions and I can apply it to your company, let me know. And we'll do some live examples if we can. Okay, so this is the balance sheet. A lot of people that I work with, as far as like my clients, they do not care about the balance sheet. I'm being honest, but it's super important because it tells you the cash that you have at the end of the month. Really, you can run a balance sheet at any time, and it should be a snapshot at that time, where an income statement is something that's over time. But your balance sheet should be a snapshot at any time. So if you were to go in QuickBooks or Xero and run your balance sheet, that should be where you are positioned at that day or whatever day it is that you ran the report. So essentially, you are looking at 3 areas. 2 areas I think are super important. The third area people don't really look at, but it helps you to understand your equity in the company. So the 2 areas that are super important, and this is you see here the general equation for assets equals liabilities plus equity, but these two areas, assets and liabilities, are where you need to be focused, I would say. So, like I said, it shows the financial position of your company at any time, it shows your assets and liabilities, and it shows your net income. So what this is basically saying is your P&L is going to feed into your balance sheet. Your balance sheet is then going to feed into your cash flow statement. But just to get a little bit more in depth into your assets and liabilities, I think we have a more detailed, let's just go through this really quickly before going to the example. So your cash, your assets, cash and cash equivalents. So all of your bank accounts that you have, that would go into your cash and cash equivalents. Your net accounts receivable. Your accounts receivable is any money that is owed to you. So let's say you sent an invoice out to a supplier and they are net 30 and you haven't been paid yet, that would be in your accounts receivable, in any inventory that you owe at cost. So it's basically how much money you paid for that inventory that will sit, that amount will sit on your assets. Your current liabilities, and let me also say current assets and current liabilities, or current liabilities specifically, are things that can be liquidated within the year, right? So things that you either are planning to pay within the year, things that you plan to receive within the year, that is what a current liability is. So any loans that you have, any prepaid expenses, this is a really simple balance sheet. But basically your liabilities are anything that you owe. Let's say you owe some salaries because it's not payday. Let's say you owe taxes. All of that would be in your liabilities. Your equity, I'm not going to get too deep into the equity section, but it's essentially your equity in the company based off of all of the activity on your income statement and your assets and liabilities. Okay, so here is an example using the same company, the Run KC company. So this is at the end of year 2. So they have 145 current assets. So again, I mentioned that can be converted into cash within 1 year. This is cash, accounts receivables, inventory, sorry. Non-current assets are longer term investments, property, any type of computers, equipment, things like that are your non-current assets. So total assets here are 164. So they're looking at their cash, their inventory, things like that as $145. Their non-current asset, or sorry, not dollars, 145,000, 19,000 in current assets. So their total assets is 164. Liabilities are any obligations that are due within a year. So accounts payable, lines of credit, income taxes, like I mentioned, like salaries owed, things like that. That would probably be another line item, but that would be a current liability. And this is also a very simplified balance sheet. What you're basically seeing now, or seeing here, is all of their current all of them, all the current liabilities, all the current assets, aggregated into this one line item. And when you're doing summary balance sheets, and sometimes projections, things like that, you do aggregate some of your line items so that it's very simple. But typically you would have different line items for the different liabilities or different assets. You wouldn't see it as just these two line items here. Your non-current liabilities, so again, not expected to be paid within a year. So loans, mortgages, the long-term things that you owe. So total liabilities here would be 99. And then your equity is the value of the company after your liabilities have been deducted. And so it gets a little tricky with your equity, but essentially your total equity and your liabilities should equal your total assets. But again, where you need to focus is really on the assets and the liabilities. The equity portion, honestly, the math should work because of what you have on your income statement already, and that'll be that net income flows into this total equity line, and so the math should always work. But well, not always, but the math should work. But looking at your assets and liabilities is super important, especially because if you ever get into a cash crunch, you need to know what assets you have that can be converted to cash really quickly, or there's a lot of things and a lot of covenants and a lot of math that's done with your liability section. If you want lines of credit, if you want loans, they're always looking at both your assets and your liabilities, but just making sure that you can cover the debt. These two areas are what they're looking at. Okay, so your cash flow statement is basically a combination of, I don't know if it's a combination, but it's a culmination, I would say, of the activity on your net income or your profit and loss, your income statement, and everything that's happened or happening on your balance sheet. All this does, your cash flow statement is it just tells you the money that's gone in and the money that's gone out. And it allows you to see like, where are you cash wise? Because your balance sheet has things on it that aren't necessarily cash transactions. So for example, and I'm not going to get too deep into this, but for example, if you send an invoice out in month 1, but you're not supposed to be paid to month 2, that revenue is going to show up depending on if you're doing accrual or cash basis accounting, but we're going to say accrual for now. That revenue was going to show up in month 1, but the cash for that revenue is not going to show up until month 2. So what your income statement does is it says, I made that revenue, but there's nowhere to put your cash, right? Because the cash hasn't actually come into your account. So your balance sheet on your assets is where it's going to say, somebody owes me that money that I made in month 1, even though the cash is not there. The cash flow statement is going to say, I haven't received that cash yet, but my accounts receivable has gone up. And so when that cash actually hits my account, I'll be able to offset that accounts receivable. I know this is confusing. So I'm sorry if I confused you, but basically it shows you that you'll be able to offset the cash that you actually received and the cash that's owed to you. And so all of these statements feed together so that you can get a good sense, the money that's coming into your account, the money that's going out of your account, and then also where the money is in the ethers, whether it's in your bank account, whether it's still owed to you in an invoice somewhere, or whether you only collected it as revenue. I hope that makes sense. What I hope really is that helps you to understand why it's super important to have these 3 documents so that at any moment you can say where your cash is. Either it's in the bank account or it's owed to you. And the only way for you to know that is by having your balance sheet and looking at your income statement to look at what you actually made and where it is in the cycle of actually being paid to you in cash. The cash flow statement helps you to do that. So this cash flow statement reports all the cash that flows into and out of your business over a period of time. This can be monthly, quarterly, or yearly. The ending cash is going to tie to the cash that's on your balance sheet, so that you know exactly, like I said, how much cash you have at any point in time. This is usually broken out into multiple sections. So this is a super simplified version, but I'm not going to go into that because without me having an example, it's really hard to see. But there's different ways that you can get cash, right? You can get cash from sales, so your net income. You can get cash from investment and loans, and those are usually represented in 3 different sections, but this is a super simplified version that does the exact same job.
Shondra, there's a question.
Oh, yes, we love questions. On the prior slide, let's go back. The bottom number equaled the assets top number. Okay, the bottom number equaled the asset. Okay. Does that always work that way math-wise? So total liabilities and equity always equals assets. Your balance sheet, your assets have to equal your liabilities. What typically happens is, well, your assets equals your liabilities plus your equity. So I'll go back to this slide. Your assets equal your liabilities plus your equity. So you're gonna come up with your assets. This is how it typically happens. I'm gonna be honest with you guys. You're gonna come up with your assets because those are very easy things for you to measure, right? You know your current assets, you know how much cash you have, you know how much inventory you have, you know how much in value your property and your equipment is. Let's say you have a office, things like a building, things like that. You're going to know that number. You're also going to know your liabilities. You're going to know your financial obligations. You're going to know your lines of credit. You're going to know how much you owe vendors, your accounts payable. And you're going to know how much you owe in loans, things like that, mortgages they have here. This total equity number, and I'm being so honest with you guys, can be a plug. It's not supposed to be, but sometimes it is a plug. But essentially, your net income flows into your total equity here. Then there's retained earnings. There's owners or investors draw, or sorry, investors draw. So this number fluctuates, but it fluctuates in relation to how many assets, how much you have in assets and how much you have in liabilities. Does that make sense? Why does the liabilities, a negative number, become positive? Negative 99 plus 64 equals negative 164. So I actually wouldn't think about it as negative per se, because I know you're looking at the equation, but what you want to look at is, it's a good question, but what you want to look at is that they equal, right? So not 164. What you want to look at is that they're equaling, not necessarily that they're negative or positive, because your assets are always going to be positive, and your liabilities and your equity have to match your assets. It's negative in the sense, like theoretically, because it's money that needs to go out of the company, but the money hasn't actually gone out of the company yet, which is why it's sitting on your balance sheet. It's still owed to others, and you still are basically holding on to that cash. That's essentially why it's on the balance sheet, because you're still holding on to it. So it's not necessarily negative yet, but it represents money that's flowing out of your company. Does that make sense? You said, okay, got it, thanks. Not negative yet makes sense. Great. Yeah, exactly. That's why it's sitting on your balance sheet, because you owe it. And so again, your balance sheet is a way for you to, at any point in time, get an understanding of where you are. I would say cash wise, but it's not a representation of cash. It's a representation of where the money belongs, like in the future, if that makes sense. So like your assets are what the value that you have in your company and or the money that's owed to you, but you don't have that money yet, but it has to sit somewhere. So it sits on the balance sheet. Same thing with your liabilities. It's what you owe to someone, but you haven't paid it yet, but it has to sit somewhere. So it's sitting on the balance sheet. And so that's why it's not necessarily negative. It's negative in a sense, but not at the time that you run this report, because you haven't paid it out yet. But as you pay things out, there will be negative balances here on the cash flow to show that either you paid out some of your loans, or you received more money from received more cash, or your AR went up or down. That's where you'll start to see negatives here in the cash flow statement. Okay, so here's a simplified version of a cash flow statement. So this company, Run KC, has a beginning cash balance of $57,000 prior to starting their business. Total cash includes all of the cash from the company, everything that they received for the month, and equity from investments in the business, loans, and borrowing. So again, any money that you receive will essentially go into your cash in calculation. And then any money that goes out, so any money that you paid to vendors, if you actually purchased inventory, any loan payments, things like that. That will go in your total cash out calculation. Then you'll have your net cash flow. So you'll take the total cash in minus the total cash out, and you'll have your net cash flow, and that will be your ending cash balance. That ending cash balance should then flow into the balance sheet as the cash available, or the total cash and cash equivalents. If you owe 99K, that may only cost 2K a month in fees. I know, I'm sorry. That may only cost 2K a month in fees and payments. Edward, can you restate your question?
On the
I don't
microphone.
think I understand. Okay, I'm gonna move on until I get another question from Edward. Okay, so
Sorry.
we're moving on to projections. This is my favorite thing to do. This is, and hopefully I have time to go through. I have about 30 more minutes, so I think we should have time to finish this.
Hey, Shondra, can you hear me?
Yes.
Oh, I just meant that the 99, which represents a negative in your math, there's a huge echo,
There is a huge echo.
may only cost like 2,000 a month to serve.
Oh, wait, what
Right.
math are you talking about? What math?
The 164 minus 99, 65, 164 math.
Gotcha. Oh, that 99. Yep. Yep, exactly.
Okay.
Okay. So sales projections are my favorite part of the FP&A process, because it's a little bit of art and it's a little bit of science, and I like to use both sides of my brain. And so when you are starting your company, when you are thinking about launching a new product, when you are trying to get an investment or loans or sometimes grants, they want to see your financial model. They want to see your sales projections. And so this is a little bit about how you can think about projecting your sales. There's 3 ways that we go over here. I typically only do one of these, but without a lot of information, let's say you're in a nascent industry, or there aren't a lot of companies or information about the ways in which the companies in your industry build their sales, it's kind of hard to kind of pull something out of thin air. So some of these additional ways are easier for you to use as a structure for creating your sales projections. But essentially, if we're thinking about the P&L and we're thinking about future P&Ls and getting to profitability, which is super important nowadays. It didn't used to be as important, but it is now. You have to think about your sales projections. So essentially, there's 3 ways to do that. You can do a comparative. So you're looking at companies that are in your industry. You can do an average. So let's say you have historical data, and you can just take an average of sales, an average of customer, average order value, and do your projections that way. Or you can do a complete bottoms up approach, where you're looking at cost of sales, the cost of goods, you're looking at the sales channel, you're looking at any wholesales that you're making, but you're looking at it basically from a unit perspective and building it up. You can do it that way. I typically do a bottoms up approach. It takes a lot of time. It is hard. And you have to have a lot of, I say, historical data, or just data in general, because there's a lot of different inputs that goes into it. All right, so here is the comparative sales approach. So you're basically looking at your industry, looking at competitors, and you can do this one of a couple of ways, but you can just do estimates of sales based on your competitors' annual sales, or you can say, my entire industry has a $1 billion market cap, and I think that I'm going to capture 0.5% of that market cap. That's an easy way to do it. But you're basically doing your research, looking at what's happening in your industry, and then deciding how much of that industry or how many sales you're going to take from your competitors. That's essentially how you're doing it. There's not much else to do there. If you're going to go this way, I would really get really clear on your TAM, SAM, SOM, so your total addressable market, your serviceable addressable market, and your serviceable attainable market. That obtainable market, that's essentially you deciding how much of your industry you expect to take. Okay, so your average sales approach, this is used if you have some historical data, or if you're also looking at industry benchmarks, you can use average sales approach here. This example says they expect 60 customers on an average day, and then the restaurant owner figures that the average price of each meal is $15. So they're looking at sales volume that way. So essentially, you're looking at historical data. You already have benchmarks, whether it's in your industry or in your particular company, that you can just say, I know that I'll probably have your business may be seasonal. You may have seasonality in your business. And so let's say June, July, August, your sales plummet, but you don't really have enough data to say what those numbers specifically will be. So you just say, on average, I think I'm going to get 1,000 customers a month, and my average order value is $50. And so I think for the year, I'm just going to do 1,000 times 50 times 12, and that will be my annual revenue, knowing that there's going to be some months where you'll make more and some months where you'll make less, but you think you'll average around those numbers. Okay, bottoms up sales approach. Like I said, this is my favorite, but it takes a long time, and there's a lot of inputs that you have to use, and it depends on your industry how detailed this can be. But you're basically looking at your cost of sales. You're also looking at your sales channel, and you're looking at your expected profit so that you can then project your annual sales. You also may look at this from a SKU level perspective or a product level perspective. So if you have multiple products, then you need to look at it from a sense of sales from each product. So maybe you have one product that takes 80% of your revenue, and another product that's 20%. So you would want to project out your sales for each of those products, knowing that you have product A is going to be 80%, product B is going to be 20%, or let's say you are a skincare brand and you have 10 products. Bottoms up approach would be looking at it from all 10 SKUs, getting a sense of the SKU mix, understanding your hero SKUs, understanding the COGS for each SKU, and then building up your sales approach that way. Also with the bottom up sales approach, you can look at sales channel. So let's say wholesale is 60% of your revenue. Your other channels are a mix of 40% of your revenue, and you can do a bottoms up sales approach from your different sales channels as well. Okay, so your cost projections. So we were on the revenue side of the P&L. Now we are on the expense side of the P&L. So remember, you have your revenue up top, cost of goods, then you have your general business expenses. So when you are projecting out your costs, there's a couple things that I would do. One, look at historicals. Two, look at industry benchmarks, because that will help you to understand really what percentage of your revenue should be going to different cost centers. But these questions are going to help you get a sense on a more detailed level of your different costs. So the questions that we have in this doc are, what different types of startup costs, what are the different types of startup costs, and then how are they estimated? Some of the ways that startup costs are estimated as a percentage of revenue. Sometimes it's a percentage increase from the year prior. So you can say this is like a general, like just something, a general rule is that, marketing can be anywhere between 20 to 25%, going down to 15% as the business grows. But understanding how much it costs in marketing for your company, for your industry. If you are a CPG or consumer packaged goods company, you're probably going to spend more on marketing than a B2B sales company. But then also understanding that sales is a completely different beast, and that's going to be a very large percentage of your revenue as well. Other costs to consider: how do costs of goods sold and operating expenses relate to profitability? The easiest way for you to be profitable is to really look at your cost of goods. That's where you can eke out the most efficiency in your dollars. Because if you have rent or a mortgage or salaries, you can't skimp on that. But if there's anywhere where you can skimp on or be really efficient, it's really in your cost of goods. Marketing is going to cost what marketing costs. And so you have to kind of follow what your business requires. Why does the way inventory is managed have an impact on profits? That's a question, but an example to that question, or example to why that question is important, is, let's say you have a company that has products, or you're a CPG company, but if you make really decisions really fast and on the fly, the only way for you to get your inventory is to fly it in. It's going to be way more expensive than putting it on a boat. And so making decisions and having to manage inventory in a really fast-paced manner impacts your profits, because you're spending more to get it to the US or to get it to your customers. Whereas if you had planned out your inventory quarters in advance, years in advance, then you can make some of those inventory decisions way sooner and not have to pay as much money to get the products to you. So that's an example of how inventory management affects your profits. And then another question to consider here: what are 3 functional areas of operating expenses? I don't really look at operating expenses in 3 functional areas, but you want to look at your salaries, your I say salaries. You want to look at marketing, and then you want to look at your general expenses. So like rent, insurance, travel, things like that. Okay, here's another example. Etsy Emmy, the bungled bangle business. Okay, so startup costs for Etsy Emmy, capital expenditures. So those are things like equipment. Let's say she wanted to get a tool or something for her to put the bangles together or to measure the bangles. Who knows? Security deposits, if there is a security deposit for office space or a workspace for her to create her bangles. Equipment I mentioned, a rent deposit, furniture and fixtures, phone, leasehold improvements, vehicles. You see what some of these startup costs. The other thing, let me just go to the next slide. Okay, so the other thing that's not on here that would be included in startup costs, that I don't think people think about, are all of the branding. Let's say I am not a big fan of hiring PR as a startup or small business, but let's say you wanted to hire PR, any type of like photo shoots that need to be done. Let me think of what else. Any contractors, any type of design work, website, literally anything that you would need to pay for would be, as you're starting your business, would be a startup cost here. So these are like very meaty costs, but there are all the little things that are also a part of starting your business that should be included as well. Okay, so how do you find and estimate your startup costs? I think this is a really good list. I'm not going to go through all of these, but they talk about marketing, they talk about team members, they talk about where your business is going to be located. Not sure what kind of businesses you guys have, so maybe there's not any furniture or fixtures that you need. But if there's inventory, let's say you're using a platform to sell your items, maybe there's fees there. All of that information are startup costs, and the way that you find that information is, one, you can ask some of your startup friends, your friends that are in startups. Two, you can ask if you have an accountant, things that they've seen when they've started or helped companies start up, or just literally list them all, which is also something I recommend. Okay. Sorry, guys. Okay. Labor. So we're in the cost of goods. We're a little bit out of order here, but you have your revenue. We just went over your operating costs. So that's the third part of your income statement. Now we're in your cost of goods section. So cost of goods are your labor and cost of materials, cost of direct supplies. Again, the usually cost of goods does not have variable costs. So if there's specific marketing costs to producing a product, if there's specific contractor costs to producing a product, those types of things aren't in cost of goods. The cost of goods is really the cost of the product, or the cost of the sale. If we get into contribution margin, that's when we get into adding those variable costs. But typically your cost of goods is just the cost of the product. So if we're looking at run KC, it's usually just the material, the work that went into putting the shoe together, maybe pick and pack, but it's typically just the cost of the good. So to make sure there's no questions. Excellent. Okay, so this last line, adding raw materials and production costs together creates the cost of goods. Okay, so these are your operating expenses. We just talked about it. There's research and development, sales and marketing, general and administrative. We just talked about this, so I'm going to move on because we don't have much time. All right, so these are ways that you can, well, before I go, because this is a new section, any questions on anything that I just went into? What I'll say is, when you are projecting your sales, you want to first project your sales using one of the three methods. Then you want to project out your cost of goods. So understand how much it's going to cost you to produce that product. Then you want to project out your expenses. So listing all of those startup costs and listing them out for at least 12 to 18 months. That will help you get a sense of how much revenue you need to make to cover your expenses, but then two, where to put your money as you are making revenue and building the business. So if you know that you need to have 20% of your revenue go to marketing, because that's how much money typical companies in your industry spend, then now you know that what you need to allocate and where you need to allocate it as you're growing your business, starting and growing your business. Okay, so any questions before I go into funding? No? Okay. Either I'm doing a great job or you guys already know this information. So it's one of the two. All right, so multiple ways you can help fund your business. But before I get to that, let me just kind of back up a little bit. So the whole point of funding your business, especially at the beginning, is because you've done all of the projections and you realize that on your P&L, your profit and loss statement, your income statement, your net income, that bottom line, is going to be less than your revenue. It's basically going to be negative. That happens, right? Especially at the beginning of you building your business. It takes some time for you to get brand equity. It takes time for customers to recognize you as the service provider that they want to go to. And so a lot of times as you're starting your company, you're not going to make enough revenue to to cover all of your expenses. And so that's another reason why you do projections, because now you've done projections for 12 to 18 months and you know exactly how much money you're going to need to run your business after your revenue, after the revenue is added in. And so you're saying, I have $100,000 hole here that I need to fill somehow. It's not going to come via revenue, so it has to come another way. And so the other ways are grants, business loans, equity investment, things like that. So that your projections help you to get a sense of how much money you need to run your business, and how much money is you're going to be in the hole for, essentially, which happens at the very beginning. That's nothing to be ashamed about. Obviously, you want to be in the black, but it doesn't always happen at the beginning, especially for high growth companies where you need really talented team members, and significant investment in building tech. You're not going to be able to cover that with revenue. You just can't, not at the beginning. Okay, so for the next couple of minutes, we'll talk about the different ways that you can fund your business so that you are able to close the gap between your net income and your revenue, or your operating expenses and your revenue. So some of the ways that I've seen, you have SBA loans. They have a lower interest rate. The repayment terms are much nicer. There are large amounts available. I've only seen a couple of folks get SBA loans, but they are out there for you. I don't know how that changes with this new administration. I have no idea, but it is something that has been offered to small businesses for a while now. There's going to be a lot of documentation that you need to provide. A lot of the SBA loans are personally secured, so they're looking at your own personal credit score. You need to have a business plan. You have to have 2 years of financials. So it's not just going to the SBA office and, sign on the dotted line and get a loan. There's a lot of information that you have to provide them so that they're able to say that you are a qualified candidate. Like I said, a personal guarantee is typically needed. Sometimes they ask for collateral. Sal, I don't know much about CDFI loans, to be honest, but SBA loans are out there for you. Okay, lines of credit. We love lines of credit. They allow you to draw down so that a bank could say, hey, I have $500,000 that I want to offer you that's going to sit in an account and you can draw down on it. I know you don't need the full 500,000, but let's say next month you only need 100,000, so you'll just draw down on that 500,000. You'll only pull out 100,000, and then you can pay that back over time. So you're only paying interest on what you need. You're not paying interest on the full 500,000. You're only drawing down based on what you need, and it's essentially for cash flow, working capital, things like that. It allows you to establish business credit, which is great. Oh, excellent. Chosen. I've written SBA loans for clients, 700K received. Amazing. I love business lines of credit. We've gotten business lines of credit from banks like BOA, Chase. There's a lot of smaller banks that will also look at business lines of credit. What I will say is that it can get really tricky. Similar to what Chosen said, very tedious for tax purposes. It can get really tricky on the reporting for the smaller businesses or the smaller banks that you use. So just be careful and make sure that all of your reporting is accurate, your accounting is accurate, because they will get in all of the details if they start to sniff anything, even looking like you won't be able to pay it back. But essentially, you can start small and they typically grow with you. So as your business grows, because they're going to be tapping into your revenue and all of your other bank accounts. So as your revenue grows, typically your lines of credit will grow. It doesn't take as long, but like I said, once they start to sniff things, they will be in everything. So just be aware of that. Yeah, that's all I have for business lines of credit. Love business lines of credit. The other thing I'll say, though, is for lines of credit, loans, those are for when your business is in steady state, or you have pretty secure cash flows because you have to be able to pay those back. That equity type of investment, so whether it's from friends and family or institutional investors, those are for experiments. But if you're looking for funding to fund your business steady state, or you have contracted revenue or revenue that you know that is pretty secure, that is guaranteed, that's when you want to look at a business line of credit or a loan. Anything where you're like, I don't know if this is going to work. I have a new product I want to launch. That's really where you want to look at equity investment, because it is expected that they may lose their money in an equity investment. That is a gamble. A line of credit or a loan is a guarantee that you are paying it back, which is also why for SBA loans, you are personally guaranteeing it, because if your business can't pay it, guess who's paying it back? You are. Okay, here's grants. These are, most of these, you don't have to pay them back. So they're just free money, essentially. There's a lot of industry-specific grants. There's a lot of grants for minority and women-owned businesses. You can even go, and again, I don't know with the current administration, but there were, and there probably still is, but innovation and research grants. The SBA even has grants that they give out. Community development grants, pitch competitions, they usually provide, not usually, but they sometimes provide grants. Sometimes, depending on who is granting you the money, there's extensive reporting that's necessary. Other times there's not. So just be aware that you're understanding what your requirements are before you apply or accept a grant. But love grants. And also, you want to think about how they expect you to use the money. So with some grants, they're restricted in that you can only use it in certain ways. So what I would do if you're looking to apply for a grant is just make sure that you were reading all the fine print, because sometimes they're very restrictive. Okay, here are some other ways that you can look at funding your company. There's microloans, crowdfunding. Crowdfunding isn't as popular anymore, but it was, a way that you can offer equity or products to your customers or fans or those that wanted to support you. Microloans are usually in like smaller community-based organizations. You see here the range is usually $5,000 to $50,000. But you'll have this document so you can kind of look at how to prepare. All right, these are ways to prepare yourself and your business to receive money and just having good financial health in your company. So you want to make sure that you have a professional bookkeeping system. So QuickBooks, Xero, anything like that. You want to make sure that you're doing your financial reporting on a regular basis. So like I mentioned, at least monthly. Always comply with your tax and have your documentation. You want to make sure your business is registered, have separate bank accounts for personal and business, and make sure that they are up to date and reconciled. Always have your tax returns, your monthly profit and loss statements. You're probably going to need all three: your profit and loss, your balance sheet, and your cash flow. They may not ask for cash flow, but sometimes just have it all. They're also usually going to ask for projections or your business plan. And then any licenses or registrations, you'll have to have that as well. Okay, so these are things to resolve before you go out and ask for loans. Sometimes grants, they will look at your tax history, your personal credit, things like that. So just make sure that you are resolving those issues. And then depending on the type of funding that you're looking at, articulating your ROI for equity investment they typically want that. But not in a, you give me this, I'll give you this. More so, this company is going to be so big, it's going to change the entire world, like that type of ROI for equity investment. Or understanding, depending on the data that you have, understanding how that's going to improve your CAC or increase your average order value, things like that. Know how much funding you need, but because you did your projections, you already know that. Understand the business objectives that you're trying to achieve, depending on the stage of your company, there are going to be different objectives. Early stage, you're doing some experimentations. Next, you're going to be doing growth. It'll change as your company ages. And then understanding your repayment strategy, but that also is determined by the type of funding. All right, I think that's it. Let me see what the next slide is. Oh, this is preparation timeline. I'll let you guys go over that on your own. I think that's it. Yes, this gets into intellectual property. I know nothing about that. Okay, any questions?
Can you just go
Good
back
at
to the
taking pictures.
intellectual slide so I can take a screenshot?
Sure. I know nothing about this. Don't ask questions to me about intellectual property, but here it is.
Thank you.
Shondra, you packed a lot of information into that session.
Great.
Yeah, I did. I would say thank you. So as a business advisor, one thing I'm very intentional about is having my clients not really jump in and do things on their own, but definitely reaching out to a professional. So I think that this was a very complex presentation, but I think it's complex as this subject is. And I think that definitely for those who are not good in this area, kind of like I'm not at all, I would definitely have to hire a professional to help me through this process.
For sure. You can hire me. I do have a team,
That's right.
of fractional CFOs and accountants. I'm trying to pull up my LinkedIn for you guys. So just give me 1 second.
We have one question in the room.
Okay.
I was looking to see what the summary of the income statement is. Like cash flow is money in, money out. Balance statement is total assets. It should equal your total liabilities plus equity. What would you say the summary for the income statement would be?
How much money you have after you have paid for your products and ran your business. So it gets down to, let me see if I can pull it up here. It gets down to your net income. So you have your total sales, your cost of goods sold, your gross income, operating expenses, basically operating the business, and then interest expense and other income. That is something that more mature businesses have. But essentially, all this boils down to how much money you have left over after you ran your business. That's the high level summary.
Oh, I think this died. Can you hear me now?
I can.
She said thank you.
Oh, great. You're welcome.
Yes. Good evening. I have a question. At what point in your business journey, is it advisable to get a professional, when it comes to your books and everything?
A lot of people start out and they do their books themselves, but essentially they end up messing it up. Then they bring somebody in and that person has to clean everything up. So you can actually find like bookkeepers for pretty cheap, $350 to $750 a month. And all they will do is go into your accounting software and just do all of the reconciliations for you. And so if you can afford it, I would have somebody start immediately, take it off of your plate, get in the habit of having someone send you information on a monthly basis, and you're reviewing it on a monthly basis. But there are ways for you to have somebody come in as early as you can afford them. There's also different platforms that will do your bookkeeping for you that's like automated using AI all of that. So that's also cheaper, but it's really hard to customize that solution. So if you have any type of complexity in your business, it may not be the best solution, but it's a cheaper way for you to get someone to do your books for you.
Thank you.
You're welcome. I'm not sure how to say this person's Charlisha.
You should unmute.
Did you call me, Charlisha?
Your hands up.
Okay. So for the bookkeeping, what do you recommend like QuickBooks or is there another one? I know you were talking about the AI one, but I've never heard of that one.
Yeah, I use all of my clients use QuickBooks. QuickBooks, some people use Zero, there's FreshBooks, but the best solution, and you can start small and then grow into it, is QuickBooks, is what I would say.
Okay, yeah, I heard of Zero before, and of course QuickBooks. Okay.
Mhm.
And do you recommend getting the certifications for it?
No, you don't need them, honestly. Or you could just have somebody else do it for you, but no, the answer is no.
Okay, any other questions? Shondra, thank you so much for coming and doing this, especially since you were under the weather. Really amazing. Appreciate it.
Thank you. I'm getting in bed, but it was great to be here. And like I said, if you have any questions, please feel free to reach out via LinkedIn. And there's a form on my website if ever you have questions, or there is a test to figure out your financial health for your company. So you can do that as well. But it was great to see you all, and I will talk to you soon.
Thanks so much.